All right, today we are diving deep into the high-stakes, kind of invisible architecture that keeps our entire global banking system from, well, collapsing. It's a fascinating story of evolution, where the rule book gets a serious rewrite after every single major financial crisis. So, let's start with the big question, the one that regulators have been wrestling with for decades. I mean, think about it. How on earth do you create a level playing field for safety when you're dealing with thousands of different banks, all using different currencies, in all these interconnected economies? It's a huge challenge. So our story kicks off way back in 1988 with the very first Basel Accord, which we now call Basel I. This was a really revolutionary moment, born out of this urgent need to manage the growing risks of international banking. And the idea they came up with was, for its time, pretty simple but absolutely groundbreaking. And this single number, this was the heart of the whole thing. The rule was super straightforward. For every $100 a bank lends out, it has to hold at least $8 of its own money, its own capital. Now, of course, it's a bit more nuanced. Regulators weigh loans by risk. A super risky loan might count for the full $100, but a safe government bond might only count for 20. But the principle is the same. That $8 is a safety cushion. It's there to absorb losses if loans go bad, keeping the bank from failing. But, that elegant simplicity was also its biggest weakness. It was just a blunt instrument in a financial world that was getting way more complex. It didn't really distinguish between different levels of risk within the same category. So as finance evolved, it became pretty clear that this one-size-fits-all rule was leaving some pretty dangerous gaps. And that need for more nuance brings us to 2004 and the arrival of Basel II. By this point, finance was just so much more sophisticated. You had complex derivatives, all these new products. The rules had to evolve. They had to go from a simple ratio to a much more detailed framework, just to keep up. And what they came up with was this famous three pillars approach. Pillar 1 was a huge change. It allowed the big banks to build their own internal models to calculate their own risk. Pillar 2 was the supervisory review, or SREP, where regulators would come in and really kick the tires on those models to make sure they were legit. And then Pillar 3 was all about market discipline, forcing banks to publicly report their risks and capital levels. A really key piece of this was something called the ICAAP, the Internal Capital Adequacy Assessment Process. This was huge. For the first time, regulators were officially telling banks, hey, you need to look in the mirror. You need to assess every single risk you face and then prove to us you have enough capital for all of it. It was a massive shift that put the responsibility for risk management right on the banks themselves. But here's the problem. This new flexibility, this reliance on the bank's own internal models, it had a critical flaw. See, it basically assumed that banks would be honest, that they would be accurate in judging their own risk. And the 2008 global financial crisis would brutally expose just how wrong that assumption was. Turns out, the models could be gamed. That was the fatal flaw. As this finding from the Basel Committee itself shows, you had different banks holding almost identical assets, but they were calculating wildly different risk levels. This excessive variability meant some banks were holding way less capital than they should have been, and that left them incredibly vulnerable when the crisis hit. The crisis taught us a couple of really painful lessons. First, the quality of your capital matters just as much as the quantity. Some of what counted as capital just wasn't very good at absorbing losses when things went south. And second, we learned that the whole system nearly froze, not just because of bad loans, but because of a total lack of liquidity. Banks literally ran out of ready cash to pay their day-to-day bills. So in the wake of all that devastation, regulators went back to the drawing board. The result was Basel III, a massive set of post-crisis reforms designed to build a much more resilient banking system, one that could hopefully withstand the next big storm. And the whole philosophy just shifted dramatically. The new rules weren't just about how much capital a bank had anymore. Now it was all about how high quality that capital was, how truly loss-absorbing it would be in a real crisis. The focus was now squarely on resilience. So they built all these new layers of defense. First, they created a new gold standard for capital called Common Equity Tier 1, or CET1. It's the absolute best, most loss-absorbing capital a bank can hold. Second, they introduced a simple leverage ratio, basically as a backstop to stop banks from gaming the complex models. And finally, and this was a first, they created global standards for liquidity, the LCR to make sure banks could survive a 30-day panic, and the NSFR to make sure their funding was stable over the long haul. And that brings us to the latest chapter. It's often called the Basel III Endgame. The main goal here is to finally, once and for all, fix that problem of inconsistency, the one that allowed banks to game the system right before the 2008 crisis. So, the core tension that regulators are trying to solve is this over-reliance on those super complex internal models. Yeah, they can be more sophisticated, but the crisis proved they could also be manipulated to get a lower capital number. The end game is all about curbing that variability by making the simpler, standardized approaches a lot stronger. And the big solution is this new guardrail called the output floor. It's pretty clever. It basically says to the biggest banks, look, you can use your fancy internal models, but your final capital number can't be less than 72.5% of what it would be if you just used our simpler standardized calculation. It's a powerful tool designed to stop the gaming and restore credibility across the board. Which, of course, leads us to the million-dollar question that everyone's asking today. After all of this evolution, from a simple ratio, through an age of complexity and failure, to this new era of resilience, have we finally done it? Is the system actually safe now? Well, banks are, without a doubt, safer. They're holding way more high-quality capital and liquidity than ever before. But here's a final thought for you. Have we just squeezed the balloon? There's a real worry that these super strict, costly rules are just pushing all the risky activity out of the regulated banks and into the shadows of finance, to entities that are way less regulated. Are we just solving one problem only to plant the seeds of the next crisis somewhere else? That's the question keeping regulators up at night right now.